So yeah, welcome to the first book club. We're going to be doing that dive into Tom Wright's Tax-Free Wealth. It's a book that I wanted to read for a while, and to be honest, the whole reason I'm kind of doing this is I have an interview with him in about a month. So this is kind of the only way I force myself to read stuff and keep myself accountable. So thanks for jumping on, guys, and helping me do this. I'll start with like a quick story on like I just finished my 2017 taxes, and I got my notes here. I made about 100,000 in W-2 salary, and I cashed out a little pension too. So from that, I was able to write off. I was able to bring $25,000 over from my passive loss side. At the end of the day, I paid about $11,000, $12,000 in taxes. So if you're doing the math at home, it's somewhere around 11 at least, maybe even 14% effective tax rate. And in the book, he talks about, the average person pays 30 to 50% in taxes. So I definitely beat that. And it all came from like the passive losses that got brought over. I know some people get phased out of that thing, but it still kind of goes in your bucket. This was like 2017 taxes that I just finished, by the way, and a lot of it is just reflecting the 10 rentals or 11 rentals I had. Again, if you guys don't know my portfolio too well, I had 11 rentals, and they were all about $100,000 plus or minus 10, 20 grand, and they all brought in about $1,000 in month in rent. That 1% rent to value ratio. So it brought in about $100,000 of income, but I was able to take $150,000 of deductions. And about half of that was the paper losses, about the deductions that we'll probably read the next time we get on a call. And the other half of the deductions were like the business expenses, spending money on courses, mastermind. We got that Tony Robbins thing coming up in March, if you guys want to get involved with that. Or we had that Sonoma mastermind. So those are ways I kind of like stuff money from like traveling to when I do that for fun. And I also like, get business done. And that's how I kind of boost those business deductions. I'm actually leaving for a flight to Vegas tonight. Going to spend the weekend there and meet up with some of you folks over there and, trying to get some business in with some fun. Part of that is I've kind of changed my business to not only being a passive investor, but kind of doing business on the side too. So Tom Wright says, change your facts, so change your tax. So giving yourself a reason to, write this stuff off. At the end of the day, I think I had like about $50,000 of passive losses, but like I said, I was only able to bring $25,000 over to offset my W-2 income. And this is kind of where things get a little complicated. And, this is definitely where I pass it off my CPA to take care of all this nitty gritty stuff. But the other $25,000 of passive losses just went into my bucket that I can use at a later date. And, that's kind of my forward to this book club. This is kind of powerful stuff. And then sort of going over some ground rules before you get started. Let's just start off with the golden rule. Don't be an idiot or greedy when using any of the stuff talked here in this one or the other future book clubs. This is just one book, and this is just like, one opinion. Urge yourself to get the inputs of other books and other personal advisors on your team. There are certain things I didn't really quite agree with in the first few chapters, and we can probably talk about that. And also you guys have access to the Google document here with all the notes. You guys are welcome to add notes now or when you guys are reading. And I wanted to there's about 13 of us on the call today. And I have some questions lined up. If you guys just want to kind of chime in and get the conversation started, I kind of wanted this to be a free for all format. Didn't really want to have too much of I didn't want to be talking the whole time. I wanted to kind of just bring you guys together. So the first question I had, and someone can just jump in, is what were some of the issues or things controversial that didn't align with what you thought accordingly? Anyone want to go or type it into the chat box? All right, I'll go, but I'm going to call names next time. So on page 12, it says invest where you travel. I've always never really believed in that. You know, it kind of, I hear a lot of CPAs, people say that, but like if the deal is not very good, don't invest, right? Like just because grandma lives there doesn't really warrant going into a bad deal next to grandma's house if you're not hitting the rent to value ratios. I mean, really, how much travel expenses are you incurring to make it worthwhile to go into a deal that doesn't cash flow what it should be? So I'm gonna start to, it's gonna be a little painful, guys. I'm gonna start to call on you guys. Greg, go ahead.
I had something on. I had something on that lane. I I agree with what you said. I kind of looked at it differently in that um, I haven't done a lot of traveling in the past 20 years because I was a wage slave, made certain sacrifices, and I do actually want to travel to a couple of places like south of France. And so for me, the way I looked at that was um, I should keep my eyes open. If I'm going to go there anyway, I should keep my eyes open for an opportunity because if I do find an opportunity that makes sense and I acquire it, then future trips to that place that I want to go anyway start to become very interesting from a tax perspective. So I guess I was like, yeah, I don't want to be forced to think in terms of where I'm going, but if there's a place I really want to go and I just keep my eyes open, then I can take advantage of this in a way that does make sense.
Right. No, I agree with you. That's for sure. I will add that, you know, if you haven't bought anything, you're not able to write off the deduction quite yet, but just keep track of those expenses. And when you do finally start up your business and make $1 of income, now you can start using those.
Yeah. Or even too, like if you go in, like say the Tony Robbins event, it's the same thing. If you go there, look at some real estate there, and you're networking and everything else, the meals, all that, you can, you know, the whole thing pretty much you can write off. So if you just make sure part of it's a trip, because I became a realtor before, like way back in the day, doing that to where everywhere I travel and I was talking to different realtors and trying to find deals, it's like I was using that to write it off and never had any problems. So that's like another way to do it as well.
Right. And that's a perfect example of like you change your facts, you change your tax, right? Like if you're just a passive investor, you can't do that.
Right.
But if you're a passive investor investing in that area, then you can. But like once you start to call yourself a realtor, not or like I don't know what you would call yourself. I mean, maybe somebody else has good ideas, but once you call yourself a realtor, now it opens up a whole new ball game and more new business expenses.
Yeah, I think there's a lot of good things in there that maybe we're more sophisticated than the average initial reader of this stuff, but still kind of inverting the pyramid and thinking in terms of this type of income leads to lots of deductions and that type of income leads to lots of taxes. I know for us it's probably pretty we got that at this point, but still it's a really important point. So even though it's kind of fluff in the beginning of the book, I still think it's a good reminder to keep thinking about that. I know I don't do the best job on some of these things. There's a whole bunch of things I've done where I go, oh yeah, I got to do some real estate while I was out there. That on the list. I like My Like You. I was going to recommend that to anybody. That's been a godsend for me. I just turn that thing on, and anywhere I drive, it takes notes, and then I go back through it every 2 weeks And I'll have like 50 to 100 drives, and I just go business, personal, and I put a little note about what it was, and I can tell you that I've already achieved like $2,000 reduction just by doing that for the past 3 months. Well, maybe 6, but it's a lot.
Yeah. What was that app again? I'll type it into the.
It's called Mile IQ, like MILEIQ. Basically, you turn it on, and you can turn it off if you want, but it's got GPS positioning, and then you just drive. So like I have this project up in Everett, which is about a 40-minute drive, and I've driven there more than I would have thought, but I can tell you that it adds up. Like, just to be quite honest, the payment on my car is $235 a month, and my deductions are well over that. So just from tracking that stuff and driving up there to oversee like the project, I'm kind of a superintendent. I'm probably at $350 a month in deductions, which is covering at least the lease and the gas, and then that's about it. So there's a little bit of depreciation I'm not covering, but that's huge. I mean, I'm driving my car for free just because I'm tracking that.
Anybody else?
I kind of something, I guess, as far as how he's talking about deducting meals and other stuff. It seems like I don't want to say controversial, but you don't, as like a regular, whatever they call it, average taxpayer as opposed to a super taxpayer, you're not as used to deducting that. So it seems like it's somewhat subjective. And when you just read a little bit about it in the book and one person's doing it, it seems kind of controversial in a way. And it's almost like you got to see other people are doing it and how they're doing it. And then if multiple people are doing it, then it's probably the way the IRS approves versus the way it doesn't, maybe. Does that kind of make sense?
Yeah, I know in the past, like, I pretty much wrote off every single meal that was over like $50.
Yeah.
I don't know if you can do it after the new tax laws this past year, because I think they kind of got rid of that. That's why I kind of wanted to read this book, because hopefully they'll talk about those specific changes. But I don't know. I would just kind of every kind of bigger meal I would have, where I would have somebody like my girlfriend with me, I would kind of just go real estate, and then it's kind of like we talk about it, right? Like, I mean, I'm always kind of thinking about it anyway. I mean, obviously those deductions can't exceed your income. Right. You can't be.
And the way he said it in the book,
Unfortunately.
he said as long as you're talking about it before, during, and after the meal, then you can write it off. So if you're talking about business before, during, and after, and you're specific with it, you can write it off. So like I said, I wouldn't write off McDonald's stuff, but bigger meals like that, 50 plus, I think you can do it and not have a problem.
Yeah,
like you said, if you're passive, it's a little bit harder. But even if it's another business other than real estate, you can write it off because it's something related to what you're doing that's making you money that you can show that you had income for. So.
Yeah, I think when you're doing the small stuff like the McDonald's, I think that kind of can be construed as like, I mean, you always have to think when you sit down at an audit, right, how you're going to explain it. First of all, you're never going to sit in audit. You should probably have your attorney to do all that stuff for you. Mm-hmm. But if you were to, like, you need to sort of explain it, right? And it just looks like you're abusing the system every time you get an Egg McMuffin and a coffee. That it's like, really, man? But like, you're exactly right. Like, you should be talking about it, but like, who cares if you're talking about it? Like, that's how do you document it, right? You got to document it the right way.
Yeah.
Yeah, I was wondering about that because I've heard conflicting stuff as far as even he mentioned like spouses and whatnot. Like getting your spouse involved with your business. And I've heard that side, and I've heard also what people say, it's kind of iffy because that's your spouse. So I don't know how that worked. I think hopefully they're going to explain it more in the book.
Yeah, before that was all fair game, right? You just had to, like, if you're and your spouse or even your buddy, or you and I went for beers, right? Like it would be, before it'd be like, you could only deduct it by 50% or something like that. But either way, you just record it and your CPA that makes that distinction. But I don't know how it is this year. I think they kind of got rid of that a little bit. But when you travel, right, those are the big deductions. And something I noticed over doing this the last like few years, like, I mean, really, how many meals do you go on? Like you go on and have a $50 meal once a week. And I mean, that's a lot already, maybe in two. Like, so that's $400 a month. If you go twice a week, it's only $4,000 a year. I mean, it's like kind of like peddly at the end of the year, even you add it all up. I mean, maybe, you know, at 25% tax rate, that's only $1,000 of savings. It's not like you're robbing the bank or robbing the IRS here. Of course, don't come crying to me if you get audited. Just golden rule.
This was okay to do.
Using your business card, credit card for, like, he said on page 26, he uses his business card on this and that. I don't quite agree with that. I'm like, who cares what business card you use or your personal card? To me, it doesn't really matter. I don't know what you guys, does anybody have a thought there?
Yeah, it just shows like the commingling of the funds. So, because I've done that before too. Well, with our businesses, where if you put everything on the business card, it's almost like having two vehicles. Like, especially if you're doing real estate, if you have two vehicles, you have one for personal use and one that you say is strictly for real estate use. It's easy to show them that you had a separate card that you only use for that, or any other business. So it's the same thing with the business card. If you're showing everything that's on here was only for business, it's easier for you to be able to write it off, even if it is like a, then you might be a squeezing an egg muffin or something like that, where it's harder if you did it with a personal card.
Yeah, but
where it looks like it's totally separate and it's, everything over there is strictly business. That's what I think he was talking about.
I know they're kind of like the book, like these guys, they try and sell each other, right? Tom Wright trying to sell you on the tax wealth ability, where their company is, and trying to sell you on their legal side too with his other buddy. They're all part of the rich dad ecosystem, but like the commingling of funds is a legal aspect, and we're not going to talk about that here. But like from a tax perspective, like what I do is every time I have an expense, I just take a picture of my cell phone and I put it in my Dropbox or Drive or whatever. So I don't do it by, here's all my tax or my credit card and everything's here. I itemize everything either way. And I think you need, in an audit, you need itemized receipt. You don't, the one where it's just like the signature line and the total, I don't think that counts.
Yeah.
You're right.
Like, I don't think
I think his advice was misleading, actually, though. It kind of seemed like he was saying, just put it on your business card. Actually, if you do that for a non-business expense, that's a different kind of commingling.
Yeah.
Right? Like you were saying. I'm not sure your name is.
I think what he was saying was he was talking about it after he talked about the LLCs and stuff like that. So I think it's kind of, he was tying it to a business expense, and it makes it easier to show a business expense because you're using a business card. It's almost how it seemed like he was trying to tie it together from my perspective.
Yeah, the one that confused me was the whole thing about Costco gas. Like,
yeah.
That's not how I do it. I think if you got audited, you'd get in trouble if you were just saying, anytime I go to Costco, I use my business card, and so it's a business expense. It really has to be the purpose of the drive. And, like the gas, they don't do gas deductions anymore. Generally, it's just mileage based.
Right.
Right.
Yeah. So I think maybe that was either dated or maybe I just didn't understand what he was getting at. I don't know. The way I do this stuff is, if I'm a broker, if I got my broker hat on and I go to meet a client, no brainer. That trip and like anything I spend there, it's a business expense, because I wouldn't have done it if it wasn't for the client. The ones that get a little weird are like a rental property that I have, and I'm talking to somebody about how to be more tax efficient with my rentals in general. I'm like, yeah, that's kind of feeling pretty businessy. But then if I have a discussion with my girlfriend over dinner about how I'm trying to save some money on taxes for like 5 minutes and it's a 2-hour dinner, I don't think that's
She told me you talk about that at every meal.
Yeah, I never shut up about that stuff. I'm told to shut up.
Maybe this is outside the scope, and maybe you already mentioned it, but I was kind of wondering, like, if it matters or even how much it matters as far as the commingling of funds. Does that matter as far as legally for LLC, whether you use your personal or, I mean, I know it would matter for like different retirement vehicles and stuff, but I guess I'm kind of wondering because maybe that's too far outside the scope.
It is though. It's corporate veil. Like if you get sued and you've got expenses that are personal expenses in your business account, or you're drawn on your business account for something that's not business, they can pierce the corporate veil and say that the business is not operating as a truly separate entity, and then they get at your stuff in the LLC.
Yeah.
Yeah, I remember that now. I feel stupid.
No. And also he made the comment about once you make your LLC, you can set up how you want, whether it's a sole proprietor, a partnership, or S corp. So it's like if you're tying it to your personal taxes, like I said, it's easier to do because it's all together anyway. So if you do it like an LLC and you're a sole proprietor, you're still going to put it on your personal taxes anyway. Like he said, until you start making money, you can still, that's why I think he was trying to use that way to say he was still trying to write stuff off, even though he hadn't made any money. I think he talked about that in a little bit too, but yeah, it's just a way of, trying to tie it together, and he can write more stuff off. It looked like is what he was saying. But
yeah, I mean, Reed, like, I think like it's more of a legal thing, but what is it? The stat, like 98% of like lawsuits end in a settlement, right?
yeah.
So whether you commingle your funds or not, it's just going to be a few more thousand or tens of thousands of more dollars that you got to pay, right? Or get sued for.
Yeah.
Right. So it's not like, yeah, it's piercing the corporate veil, but like, it's like, well, how does that settlement calculated, right? And I'll be honest, I got commingle all myself all the time. I don't care. It's just ridiculous. I got too much junk to take care of, right? And it's just I'm not trying to make more money.
Put Lane on mute for a second.
Well,
it's too, like, if you're doing you should be okay. If you're doing other stuff like trying to side stuff, yeah, somebody will try to get you on the IRS bill. But they say if you're doing everything up and up,
yeah,
they're not really going to mess with you too much.
Yeah,
so the commingling only matters from a legal asset protection standpoint if you're going to get sued for liability. Then it's not going to matter for like an IRS audit, as long as you track your expenses, whether you take it from your personal bank account or whatever. As long as you can, that's not going to matter from a legal perspective as far as getting audited from the IRS, is my understanding.
Well, so here's the thing. Like I work for the governments, and I work with a lot of auditors, right? So when the auditors come around, if you don't have your shit together, now they're gonna start like sensing blood, right? And they're gonna start digging
look for something else, yeah.
And they're gonna eventually find something. But if you got all your stuff separated, right? Like you look pretty clean, and that's if you get audited, right?
Yep. Yeah, my bookkeeper, what she does for me is if I use a personal card or something like that for an expense that should be business, at the end she basically has my business write me a check. It's kind of like an expense reimbursement, and she says that'll cover it.
Auditors love that, Elo. They love that.
I just do what they say because they're smarter than me, and they're like, yeah, just do this, and it's like expensing. I'm like, oh yeah, when I was a W-2 slave, I remember doing that with my business. Oh yeah, they're probably right.
Yeah, that's what W-2 employees do, right? They spend all their time line iteming this stuff over when it doesn't even matter.
Yeah, I did a lot of things that didn't matter when I was W-2.
All right.
But
Anybody?
It gets you used to thinking about it, though. It gets you used to thinking about it. It does.
Anybody else who's been a little quiet, like want to mention something or any takeaways?
My perspective was the whole deal with the business credit card was just for organization, really, more than anything else. I think it's more of a personal preference. So, and me personally, I'm at the stage where I'm trying to figure out what kind of an LLC to set up. I did buy that Garrett Sutton book as well. So, since I've mainly been passive at this point, so I don't know if it's going to get into it in this book at all or not, but, deciding if it's best to take it as a sole proprietorship or a S corp and see how things go from there. I don't know. I also had a call recently with a tax hacker. I don't know if anybody's done any investigation into their group at all, but there's somebody that's comes up on the Epic Real Estate podcast quite a bit. So they had some advice about these areas as well.
I have another thought or two. I did a webinar for Wealthability. Not a webinar. I talked to those guys a while ago. It didn't seem too bad. They got a program. I'm kind of slightly disappointed in the book though, because he's doing it to appeal to a lot of people, including people from other countries. I'm kind of disappointed in that the book is more generic than maybe it could be. It's just like, write the book for the U.S. I guess is kind of, I don't care about Canada's tax agency or Britain's tax agency or any of that stuff.
Well, I mean, the book is like a business card, right? It's a modern day business card. I mean, it's just supposed to whip your appetite enough so that it's good content marketing, and it is what it is.
Also, it's kind of weird. I talked to him.
Sorry, go ahead.
I was just saying it's kind of weird because when I was reading the book, I talked to him in person, heard him on podcast. So it was like I was reading it, and I was like I was hearing his voice talk to me almost.
Yeah, there's a lot of tax stuff I'm encountering right now that I think it's pretty interesting, but I don't know. It's more concrete and it's more about the U.S., but I just don't know how relevant it is to everybody on the call. Like, I learned some stuff about opportunity zones yesterday and talking with my CPA. But it's kind of an active thing. Like well, it's not really, because if you purchase rental real estate in one of these opportunity zones, you get to defer the money coming into it if it's in an opportunity fund. So like if you have a property and you sell it and you have this big gain, you take all that money and you put it into an opportunity fund that is rehabbing a property in one of these zones. You don't pay tax on the gain. It works like a 1031, but if you hold that property for 10 years, you pay zero capital gains on the property that you just bought into and fixed up, which is this massive tax shelter. If it works for you, and it just turns out that the project that I'm doing right now is in Everett. It is right in the middle of one of these opportunity zones, and my LLC, that's the only thing it owns, so it meets the criteria. So, if you were to buy a rental with, taxable gains, and it happened to be in one of these things, you could avoid like a huge amount of taxes. Like I did the numbers, it was like 80,000 in taxes. So I don't know if that's what you meant as far as more specific stuff that's specific to the U.S. that you can act on. I'm hoping that later on in the book that there's more stuff like that. If anybody wanted to know about that opportunity zone stuff, I pretty much understand exactly how it works now after 2 hours of my CPA. So just ask. it would matter if you're buying into an area that the government is incentivizing people to buy and fix things up, or maybe buying returns or something like that.
Yeah, and I have the simplepassivecashflow.com /opportunity-fund-zone. But if you're a passive investor, this kind of really, I don't know. I mean, it's kind of more of a marketing ploy, if anything, I think, for a lot of people. And there's a lot of funds being created for this stuff. And it's kind of like that thing where you don't want to spend money just to get a tax break, right? You don't want to blow $1 to invest it in something that sucks just to get a tax break. It's kind of dumb. But
yeah, I think they still have to tweak it, because what happened for my property was the rule is the improvements you have to do have to be at least equal to what you pay for the property. So in this area, it's impossible because it's way too expensive. But there are tons of places in the markets where you're doing your syndications and stuff where you could buy for 80,000 and fix up for 80,000, and that would be a very good. That would be pretty good.
Okay. Well, if anybody has like a question they didn't understand, write it into the group chat. There was one more thing I had that I didn't quite agree with, or maybe I don't like how they keep using this again and again. It's the paying your kids thing. I think it's a little lame. I'll probably write an article about it just because everybody else does it and people like to talk about it all the time, just like how people like to talk about the coffee farms with me. But so the idea is you pay your kids, I don't know what it is, like $1,500 or $3,000 or whatever it is up to, so they fly under the radar, so they don't have to do a tax return, and you're able to kind of carve that off of your active income. But I think the good is like you're teaching them sort of business skills if you just don't give them money and you kind of pay them for doing some kind of thing in your business, which is always good. So you just don't create trust fund kids. But it's kind of small potatoes, and it's kind of a headache if you ask me. If you're trying to do your kids' college, they're saying, well, have them put the income into a Roth IRA, that you paid them because it's income they make, and then they can invest that in the next 15, 18 years or whenever, and then you can withdraw the contributions tax-free, penalty-free for college. And then, but I personally think just setting up an infinite banking thing is probably better than the Roth IRA idea. But either of those two is way better than that 529 garbage.
What do other people think about that? That's the infinite banking versus 401k Roth. If you don't mind my asking, I'd love to know what people think about that because I've been noodling on that one for a while.
I mean, the Roth, what I don't like about the Roth or the 401ks or any retirement accounts is you can't touch it till you're 65 or whenever. I would rather have the money now today and start building my pension today, sort of backwards how everybody does it. And the bad thing when it's in like a Roth or a 401k is you can't leverage it, right? You can't get loans. I mean, you can, but the terms are gonna be horrible. The only way around it is
unless you have
put
$3
into
million
a,
in your 401k, then you're right. But
yeah.
That gets to my question though that I've been thinking about, which was, I mean, I have 180,000 in my retirement from my
the 401k.
Yeah, it's a solo 401k, so it's nice. But like you, I'm kind of like, well, I could just liquidate it. I'd lose half of it. But then I could roll into banking or something else because more liquidity and more flexibility. Yeah, probably in 5-10 years, I'm starting to come out of it.
No, we're kind of losing you there. Your audio is not very good.
Sorry. Yeah, the situation basically is you've got the Roth 401k there. It's got about 200,000. Do you leave it in there for like the tax-free interest growth, or do you liquidate it? Probably lose half of it, and then take that and start doing something with it because now it's liquid and you can actually invest it better. I'm guessing in a 10-year time frame, if I put it into infinite banking and then used it, I'd probably start coming out ahead.
Probably. I mean, the question is how well can you grow it, right? I mean, if you're like most people who can't grow it for 10% or less, probably where it is better. But if you're probably better than like 10, 14%, take it out, pay the penalties, and then, you probably recoup. It's just calculation of when do you recoup it, right? When is the crossover point? Do the math. The math will tell you what to do.
Well, the math says take the hit, or at least do it in a year when you don't have really high income. Because to your point, like many of us, if we're doing like our little side businesses, or even if our passive income on a rental, I mean, you could be cash flowing 10%, you're making 10, 12, 13, 14% on the back end because of depreciation and appreciation and all that, right? I mean, you're definitely going to beat, 12% over the long term. So I don't know. It's been hard because I don't know. Probably nobody on the call wants to take $100,000 haircut and just be like, oh yeah, because you're going to make it back in 10 years, but then year 20, 30, 40, you've made a lot more.
I'm not sure if this is correct, and Lane can tell me if I'm wrong if he knows, but at least from some of the stuff at the syndication seminar, it seems like you can take some investments in some energy things and you can use that to offset active income, unlike any other businesses, unlike other real estate stuff, unless you're a real estate professional. So I've been kind of wondering about that, and I don't understand all of them, but kind of have a very
Yeah,
vague.
so this is kind of getting to more of like an advanced topic, but I'll kind of go over it real quick. Like, you got a guy who has like 200, 400 grand in their 401k and like they want to like cash it out, right? So they're going to have this huge AGI bump, right? And they're going to be in that highest tax bracket. So two things you can do, like how Reed's saying, is like go into an oil and gas and get the IDCs. You guys can Google that on your own. The government wants to incentivize you to invest in oil and gas, which is a super risky investment, and I wouldn't recommend it because the operators are all over the place. But on that, like if you invest $1, they'll give you a big tax credit. I forget what it is. It ranges, but like the second option is this like thing called like a land conservation easement. So the government sees it as a taxable donation, like a charity. But unlike putting $1 into the Salvation Army tin, they're going to give you the value of the highest and best use for that piece of property. So if you got like an acre of property and you donate it, they're going to like give you the value for the highest and best use. If it's Hawaii, it's like Ala Boulevard. So usually if you invest $1, you can get $4.75 of taxable or tax deductions. So if you put in 100 grand into land conservation easements, you can get like 500 or almost $500,000 of deductions, offset that big 401k withdrawal. So those are two ways
like
of kind of doing it.
Conversation.
Yeah, that'll be a lot offline conversation. We'll kind of leave it at that.
That sounds very attractive, though. Like,
yeah,
pull 100 out, you take 25, it covers the 30, the 75, and you just get 10% help. That's all right.
Yeah. But yeah, I mean, I guess, was there anything else anybody want to discuss in the first 6 chapters? Wasn't too much in there. Hopefully it gets a little more juicier. I think it will.
Did you get a distinction between active and passive? I found it a little confusing because there's the latter couple chapters. It was like passive investors are super investors who are investing in, long-term buy and hold, that. But then he was kind of talking about active real estate investors as if they were doing that too. And I always thought active was, I flip a house.
Yeah, there's I have it written down somewhere where there's like this is not the discussion on like if you're a real estate professional, you don't have a W-2 job, you most of your hours. There's like this 7-part test, and I'll try and put it in our shared notes. But that kind of determines if you're an active participant in your deal. And it's kind of hard to get. I think that's it. I don't understand. I don't understand what's active and passive. Like, I get my K1s from my syndications. I don't understand like what is active and what is passive from it. That's when I kind of give it up to the CPA. But I always tell you guys, like, you guys should know a little bit to be dangerous.
Yeah, I was a little confused on it. I think he maybe meant like you're active. You drive to North Dakota, look at a property, and say, I'm going to buy it. And I think that's active as opposed to, I went to my computer and I bought stocks on Vanguard. That's passive. But I'm not.
Right. All right. Always trying to finish this stuff earlier than we need to. If there's any last comments or questions, type it in the chat window or come off mute. Last chance here. But yeah, so the homework assignment for next time is read chapter 6 through 11. We'll meet again on January 4th. Same time. I think that's a Friday too. And have a happy new year. And if you guys like stuff like this, I'm launching a group coaching thing. Shouldn't be too expensive. It's not gonna be some BS like $5,000 or higher kind of program like some other things. It's gonna be group calls like this bi-weekly. Let me know if you're interested. That'll probably be coming on the next month, but I guess we'll see you guys next week.
Right on. Take it easy, guys.
See you guys. Bye.
Thanks.
Yeah, everybody.
Thank you. Happy New Year.
Happy New Year.